Hey guys, welcome to Make Money Count. This week we have another exciting thing that's changing in the mortgage world, which is the ability to refinance your home to 90% loan to value.
It's nonstop.
It is nonstop. It's fun. It is good. It is good. But
you know why I think it's, well, I don't know whether it's good or bad, but you know what I think? I think it telegraphs to us the intentions of the federal government.
right.
I think first of all, I think the federal government realizes that we're in a bit of a conundrum because we have relied so heavily on real estate to prop up our entire economy. And I think that now that the response that perhaps the federal government was expecting from the Canadian home buyer or homeowner to reduced interest rates or the prospect of continued reduced interest rates hasn't really come to fruition, right? Like the real estate market's pretty dead still. And I think that what we're seeing now is a playbook of like, let's throw some things at the consumer to try to get this market flowing again.
Right.
So we saw the first change was the $1 million to $1.5 million 30-year amortization, first-time home buyers.
Yep.
And now we're seeing, you want to rip us through this? What was this announcement? Like, what is this?
Right. So basically what the government of Canada said is that to help with the housing crisis, they're going to allow you to refinance up to 90% of your property's value as long as the money is going to build auxiliary suites or rental units. Actually, not an auxiliary suite. It has to be a rental unit. Like they have to rent out the space. So to build up to 4 rental units on your property. So
in the press release, she was saying like how she wants it to be family members and
right.
So that doesn't that mean auxiliary? I don't know.
Yeah, I guess so. I mean, it said rental units, but yeah, I guess
it is. It now is going to allow Canadians to borrow up to $1.8 million insured by CMHC, federal government, in order to renovate their home, basically, in order to add units. So everybody that is interested in trying to add some level of rental income to their home and is comfortable with a garden suite or a basement apartment or multiple apartments or a garden suite and a basement apartment can now go out there, borrow more money against their house, pay a significant insurance premium, hire a contractor, and hope that they don't have an experience like many people have. Like, how many people have we done mortgages for where the experience was, I hired a contractor and I paid the contractor and the contractor screwed everything up.
Yep.
And now I have no work done, no money, and a lien on my house
and
from
a construction lien.
And a construction lien.
Yeah. I mean, it is more common than we would like it to be.
So
That's
I would say, like, I have 2 comments on this, okay? The most simple and unfortunately cynical, I hate it, right? My mom said, like, she likes it best when I'm not cynical about these things. Maybe I'm just cynical. I don't know. Listen, I'm concerned that CMHC on June 15th changed their underwriting guidelines for purpose-built rentals.
Right.
Okay. So if you got an application in prior to June 15th, you would be able to get an extended amortization and you'd be able to access more loan to value. So you'd be able to borrow more and get a longer amortization with fewer credits required for energy efficiency. That changed on June 15th, essentially tightening that rental program. So making it more difficult for builders to build purpose-built rental buildings in major urban centers because it's easier to do affordable outside of like Toronto and Vancouver.
Of course.
Okay. So I guess it's because they want to see real affordability or real, like, more energy efficient buildings. So we're pushing for that at a time where it's already not economical for builders to build buildings. And then they come out and they announce that this discrepancy, this reduction in the number of rental units resulting from this policy change, we're going to supplement it by getting John and Jane homeowner to add the rental units that we're missing. It just seems like, I believe Canadians are smart. I believe Canadians are competent. But like, first of all, John and Jane homeowner, okay? Let's pull out a case study, okay? Let's imagine these two.
Okay.
They have a house and they want to pull out $300,000 to build a garden suite. You know what? It's not $300,000. It's like $400,000, $500,000.
Yep.
Okay. So they're going to pull out $500,000 to build a garden suite. The numbers will work on 500 grand because if it's in Toronto, they're going to get the rental income. But do you know how much income they need in order to qualify for the $1.8 million mortgage?
Yeah.
300 grand?
It's a lot of money.
290?
Yeah.
Okay. So what do they do that earns them $300,000 in family income a year? Like, I don't know how much spare time they have to vet and manage a contractor for a major $500,000 construction program.
Right.
That's going to be happening at their house with money that's not theirs.
Right.
It's theirs. It's the equity from their house. I like, that worries me.
Yeah. No, I hear you.
That worries me.
And like, how are they going to kind of manage this process with the borrowers, right? Like, I'm interested to see once it starts, how the process actually works. And we were talking about the Airbnb thing. Like, how do we know that John and Jane homeowner are just going to be doing this to put it on Airbnb or whatever the case may be?
Yeah.
Right?
What are the controls?
Yeah, exactly.
Like, what's the governance of how this money goes out there?
Yeah.
Like, as it stands right now, generally speaking, lenders rely on title insurance and not legality of units to lend on a property.
Right.
Right. Because so many units in the city of Toronto are illegal units.
Yeah.
Right. So are we now are we now going to put controls on that CMHC money? Like, do the brokers or the lenders have to verify that the units are legal in how they are being constructed, in which case it's going to be a little more expensive to construct these units. I agree they should be legal, but there's a lot to this.
Yeah.
And we're putting a lot on the homeowner. Like, it's a really weird time, right? Like, remember we used to talk about the supply problem? Like, it doesn't really look like we got too much of a supply problem
Definitely
this
not.
exact moment in the Toronto housing market, okay? Canadian in general, but let's think about major urban centers because rents are dropping, prices are dropping. As a result, nothing's getting built.
Right.
So the supply problem that we thought we had, we're creating. For sure. It's like my dad used to tell me whenever we used to, like when my brother and I were learning how to drive, don't look at the fucking guardrail.
Right.
If you look at the guardrail, you're going to
drive into it.
The guardrail. Yeah. You know that one too?
Yeah.
My dad taught you how to drive?
Yeah, totally. You don't remember?
No.
Yeah.
Anyways, I'm worried about the amount of risk we're throwing on to the homeowner. I think as a result, I think you're not going to see, like, I don't think either of these two recent CMHC changes are going to do anything until the next shoe drops.
Right.
So I think what we're seeing happen right now, and you love my analogies.
I do.
I think what we're seeing happening is I think we're seeing the rules for the new, like the borders of a new game being developed.
Like the goalposts are moving.
The way I would imagine, the way I want to say it more is like we're building an aquarium, a new aquarium. Like we're putting the glass up. We have an aquarium right now and it's like this big.
Right.
And we're putting glass up around that aquarium. And we're like, okay, we just put one piece of glass. We've got another piece of glass. So the first piece of glass was like, okay, CMHC is going to go from $1 million to $1.5 million on the first time home buyer house thing. 30-year amortizations. Okay, we got another piece of glass here. We're going to put it over here. $2 million refi, $1.8 million. Just get the money out to the homeowners.
Yeah. No stress test on transfers.
Yeah, no stress test on transfers. That's critical.
Yeah.
There may be even like a few more pieces of glass coming out.
I think so. Yeah. I would expect it.
And then they are going to take the pieces of glass out of the little aquarium in the middle. Boom.
Yeah.
And the water is going to spread. And then they're going to put more water in. Somehow I have to make sure that the water level rises.
Yeah,
it'll help my analogy by removing the stress test altogether.
Right.
Because you like all these rules that they've implemented here. It's like saying, you know, Billy, you can eat all the candy you want, and then putting it like 3 feet above Billy where he can reach.
Where he can reach?
Right. And then bringing out the 3-foot stool afterwards and being like, oh, here you go. Here's the stool. That's when the candy binge happens. I don't know if like
the stress test was good in its place though.
I mean, it certainly helped when.
Like, could you imagine what we would be dealing with right now if people had to qualify at 1.49%?
Yeah, it'd be a problem.
Yeah.
Anyways, that's what I think. I think this, because none of this stuff's going to be enough, then the next announcement's going to be, okay, well, maybe there's another piece of glass for our aquarium. But I think the next announcement is going to be like, okay, one of the new next announcements is going to be, okay, stress test is gone.
If it wasn't, the stress test wasn't the next piece of glass, what would the next piece of glass be for you?
I don't know. I'm not smart enough. I don't know. Like how many, so you have to think like, who are the lobbying groups and the stakeholders that want things right now and who are the most powerful, right? So I think like that the banks are the most powerful lobbying group in Canada. And if you allow CMHC to guarantee more of their high risk loans. Like bingo.
Yeah.
And what we saw happen previously when Bill Morneau, the previous Minister of Finance with the Liberals, when he removed the portfolio insurance product, is you saw the banks eliminate competition from competing non-mortgage finance or mortgage finance companies, non-bank lenders that had access to great rates.
Right.
Because they were using the CMHC portfolio insurance guarantee.
Right.
We removed that and rates went up. Banks made more money on net interest margins. But the unintended consequence of removing insured refis and portfolio insurance was that we saw a resurgence in private lending.
Right.
So like mortgage investment companies, of which we have one, became very successful, started spitting out a lot of yield to Canadian consumers, Canadian investors. And maybe the banks now are saying, we want to get into that business by allowing them to kind of start lending more into that space. And since they can't do it the way the B20 guidelines are set up, they can do it. If you remove the stress test, they can start lending more aggressively into Canadian consumers at a time when property values are low. Listen, I don't know what the end result is here. I can just tell you that it telegraphs to you that the federal government is concerned that real estate prices haven't come back, and that the anticipation of this next 50 basis points, which everyone's counting on, maybe the employment numbers in the United States make it a little hairy. You asked me today. What did you ask me about bond yields? The
bond yields going up, yeah.
We saw bond yields spike 30 basis points since mid-September.
Yep.
And it's because of the American employment numbers, right? American employment numbers came in higher than anticipated. Those may get revised down lower at some point, but that it just shows you how interconnected everything is, right? So if we cut 50 in the face of that, our dollar's going to weaken. Our dollar did weaken, right? And our dollar weakened because we're anticipating a big rate cut, and the United States employment information came out stronger than expected.
Right.
Meaning that the United States, the Federal Reserve, although he's been pretty clear in telegraphing that he wants rates lower, and he's given like the FOMC minutes, and he's really been transparent in like what they're going to do, right? But I think, they're data dependent, just like any central bank. So when the data comes out that the employment is stronger than they thought, maybe they don't cut as quickly, which means if Canada cuts quickly, we got a problem. The other thing is oil prices, right? Tensions in the Middle East are high. So oil prices spike. That has an impact on inflation because gas prices are part of our CPI number.
Right.
So both of those things, I think the U.S. employment number plays way more heavily into that number, but both of those things spike bond yields. The good news, and I say good news because everybody right now should be thinking, what is it going to cost to break my mortgage? Everybody that has a 5-year fixed rate mortgage that's kind of like above that 5.5 mark, you should be thinking, what is it going to cost to break my mortgage and switch to a variable rate mortgage? And when we see bond yields spike 30 basis points, that means that the penalty to break your existing mortgage is coming down.
Right.
Right. It means that because you're very likely going to get subjected to interest rate differential. If you are subjected to interest rate differential penalty, that 30 basis points is basically 0.3% off of your penalty, probably equates to like 20% reduction in your penalty. It may even switch you from your penalty being interest rate differential to being 3 months interest, which could be even a more significant reduction. So the critical thing for Canadians with mortgages right now is you should be analyzing whether or not it makes sense to break your mortgage and switch to a variable rate. And I said this in the last podcast. I'm going to say it again because I think it's really, really important. And it's where Canadians are going to get screwed. You're going to leave a lot of money on the table if you wait for the variable rates to come down lower. The discount off the variable rate that's there now won't be there then. So if you can get 1 point below prime on a variable rate mortgage right now, you got to start contemplating whether to break your fixed mortgage and go into that product. Because as variable rates drop and fixed rates drop, penalties will increase and it will cost you more money to switch, number one. Number two, the variable rate mortgage that you're going to switch to might not be prime -1 anymore. Okay.
I mean, yeah, during COVID, when we saw the last drop in interest rates, variable rates literally went from prime minus. I remember there was a day where I was sitting at my coffee table, Saturday and Sunday. I must have made 400 calls in 2 days, just talking to all our clients, telling them move from a fixed to a variable because rates are going to go down. And then rates went from prime minus 1.2, prime minus 1 to prime plus 0.2, right? There's a huge change in that, slashing that discount to the prime rate. So, yeah.
Anyways, like, just to kind of put a pin in this, federal government is very keen to see real estate prices stabilize, if not increase. They want to see buyers come back to the market. They want to see the economy get back to work. And they feel as though if they offer people money to renovate their homes, that's going to happen. And I don't think it's going to happen until they remove the stress test, because the amount of money that's required to qualify for these gigantic mortgages is just way too high. So I think you're going to see amortizations get pushed out. I think like the damage that we inflicted on everything is like a cause and effect, right? So when we printed too much money for COVID and behaved irrationally, we caused a problem. And we tried to solve that problem by smashing the Canadian economy with extremely high interest rates to freeze the economy. So we didn't want COVID to screw up the economy. We wanted to do it ourselves. So we hiked up interest rates to such an extent, assuming that the only thing that we would ever need to fix our economy would just be to lower those interest rates. But interest rates don't just operate in a vacuum, right? When they go up, they affect other parts of the economy. They affect employment. They affect consumer confidence. They affect consumer spending. They affect capital expenditure. They affect business sentiment. They affect all of these parts of our economy, all of these factors that influence our economy. And then dropping interest rates takes time to repair all those facets of our economy. And now that we're in this period of time where we know interest rates are coming down, but they've been high for so long, and not even that long, but they've been high, affecting people for so long with a huge debt burden on people. People are starting to do the stinking thinking, and they're starting to say, we're not productive. We've been relying on immigration. Are these houses really worth what we've been paying for them? And they're being slow to re-enter the market. And, I think the fundamentals are this, right? After stinking thinking comes optimism.
It's a pendulum.
Yeah, and we're going back in that direction.
100%.
So I've said this for a while. I think 2025 will be a better year. There's no fall market, obviously not. I think spring will be a little bit better. Fall will be better than that. Interest rates will continue to drop. Optimism will return to the market. But I don't think 2025 is going to be like this super banner year that everyone's expecting, depending on that stress test thing. Maybe that stress test gets removed. But I think, like, in order for the Liberals to call an election, they probably have to remove the stress test.
Why do you say that?
Well, if they remove the stress test, it will light a fire under housing.
Right.
Housing is the GDP of the country. Canadians will feel more comfortable, but
they'll look like heroes.
That will let them call an election. I don't know if it's enough to let them win an election.
Yeah.
I don't know, man.
We'll have to see.
Anyways, don't like, don't subscribe. Don't care. But keep watching. And enjoy it. And thank you very much for watching this one.
Do, however, drop us a comment if you have any questions, because we love answering your questions.
Yeah, sure.